You know that every year they come out with these words that are like the most popular words that end up in the English dictionary. I think that bubble might be one for 2024 as we look at the stock market. My name is Jeff Miles. I am joined right now by financial advisor Jimmy Lynn. This is the Right Path to Retirement podcast. And Jimmy, your website, want to make sure people have that as we get started. It's rightpathtoretirement.com. Go to the website so that you can get a lot of the information. And if there's parts of this podcast that you're listening to right now and you're thinking, oh, I didn't get a chance to listen to the whole thing, just go back to the website because it will be posted there. And we'll make sure you are able to get all of the information today. And Jimmy, today we got to talk about something that Harry Dent from Fox Business, known to have a pretty intense opinion about the stock market and how it's doing right now. He says that the rapidly increasing stock market could be bubbling right now. And every time somebody hears bubble, they immediately think, okay, it's going to burst. And if it bursts, then what? Right?
Right. So, well, I saw that video. And there's a lot to it that I agree with. I mean, the market is red hot right now. I mean, as of this recording that we're doing today, the S&P is at another all-time high. Yeah. So it doesn't seem like it's going to slow down, but, you know, history tells us that there are going to be bubbles in the way. And that's the thing is that you don't want to be caught in a situation where you weren't prepared for that possible bubble, right? I always believe that you just want to kind of be prepared for all market conditions. So you really got to listen to what Harry says and you know, kind of plan accordingly for that possibility.
When it comes to someone putting that kind of information out there, as far as there being this potential bubble, how do you help people when they feel like they could be in that situation and, oh no, do I need to get out now? How do I get out now? What are my alternatives? Where do we go from here? It's like a bunch of questions, but I imagine it kind of all ends up in the same place.
Yeah, absolutely. I mean, a bubble shouldn't be something that someone fears if they're allocated appropriately. I'll tell you that the majority of my clients, they are not fearful of a bubble because the way we kind of look at our clients' account is we give every dollar a job. Right? You have some of your dollars are meant for growth. So long-term growth, you want to take advantage of that market. You want to take advantage of what NVIDIA is doing for the market. But some of your dollars you're going to be using for your income as soon as you retire. So you want to take a cruise or you want to do some renovations to the house. You want those dollars available as well. And you still want some growth there, but you may not want to be exposed to as much risk. So with our clients, the way they're balanced is really kind of having those dollars that are allocated for the long term. And at that point, we're not really fearful because, I mean, knock on wood, every bubble has come back. So we've had multiple bubbles in the history of the market, right? We had the most recent one with the coronavirus. We had the financial bubble. We had the dot-com bubble. So we've seen multiple scenarios where the market has come down significantly. But look at where we're at today, right? We're still at an all-time high. So as long as you have funds allocated for the long term, you really don't have to be fearful. As long as you have that bucket of money that's kind of insulated from the market, but still can get some market-like growth. The scary thing is that if you don't have a plan in place, what we often see when people come in to do like the portfolio analysis that we've spoke about in the past is we'll look at some statements of people that are about to retire within like a year. Yeah. And the way their investments are allocated are the same way that they were invested in their 20s, 30s, and 40s. And that could be a recipe for disaster because oftentimes those are very heavy in the equities and like S&P 500, and that could definitely be exposed to some downside risk.
Things that might be more aggressive, and you're getting into the less aggressive time in your life if you're about to retire here in the next year or two. Maybe it's time to look at things that are a little bit more, I don't know. I don't want to use the word cautious as if to say that it's not going to be benefiting you, but at the same time, maybe less aggressive to kind of help you for that long term, especially as you're going to get into the spending time of these accounts, correct?
Right. No, absolutely. I mean, we always equated to this. Most of our clients that we've worked with, they've diligently saved for retirement. So oftentimes they're coming into our office with $500,000, $1 million, or 1.5 million saved in various types of retirement accounts. And I always kind of make it very clear, because we were taught at a very young age and early on in our investment careers that, when you get your first job and you're just saving your 401k, that it's all about growth. Right. It's all about growing your assets as much as possible. And rate of return is a big term in the industry. But when you get to the stage where you're just a few years from retirement, I always tell people you've already won the game. Right. So if you kind of take it from like a football analogy, when a team is up by like 3 touchdowns, they're not still running the ball. I mean, they're not throwing passes, right? What are they doing? They're running the ball because they don't want to be
running
exposed,
the clock out is what they're doing.
Exactly. So they're at the point where when you're retired, you've worked hard and you've done well in the market. Now it's time to maybe take some chips off the table, to use a Vegas analogy, and really reallocate those assets, give them all a purpose. Now, you could still have some of your money in the market because, nobody wants to miss out on that NVIDIA or that Meta growth. But make sure that some of your assets are protected because you're going to be using that sooner. And there's a lot of different strategies that can be employed where you have assets that are insulated from market risk, but still can get some really reasonable growth.
When it comes to like the stock market and, this idea that it could be in a bubble and whatnot, but then you also have the flip side, which is, interest rates are still high. They're going to be held high, it looks like, for, some time. We don't know exactly when there's going to be a pullback on those interest rates. It looks to me, and I'm not the financial advisor here, so I'm just the other guy over here asking you kind of how this looks, but it looks to me that as you've got the stock market, which is performing well currently, but then you also have interest rates, which are higher than they had been over the last, 10, 15 years. It almost seems like there's a way to be able to kind of place money in different ways where one kind of protects the other. And then you've got a situation where as one, if it tends to look like it might be underperforming a little bit, well, we can kind of move that over here to maybe something that is performing a little better.
Right. I mean, there's a lot of options right now. I mean, inflation's a scary thing. Interest rates are high, but there are some benefits to that. Obviously, you want to still be invested in the market somewhat. I mean, everyone's situation is going to be different, but it allows you to have the best bet to keep up with inflation. But having said that, with the interest rates the way they are, oftentimes, especially with retirees who just are sitting on large assets, you could put some of this money in high yield savings accounts that are really paying well, or we have different types of bonds that are paying great interest right now just because of the way the interest rates are looking right now. And so there's a lot of flexibility. The downside, obviously, is things cost more right now, but you could still take advantage of the situation and make sure that at least your money is working for you and keeping up with the inflation and the interest rates.
When I was a kid, the way that you were taught things when it came to economics and finance and stuff like that, it was always like, put your money in that CD, go to the bank and put your money in that CD, because interest rates were really good back in the 80s, right? And then they got, to a place where it was like where you weren't making any money necessarily having your money just in CDs or accounts like that. And I think people were kind of looking at the stock market as kind of like the biggest way to see those big gains. But it does kind of feel like we're in a time right now, as much as there's the inflation, conversation that's constantly happening right now. A lot of people, they look at the economy and they're like, well, the economy is some people say it's robust, but then other people say, well, it's not anything near what those analysts are saying. But when you do look at this from a retiree's perspective, it does look like you can go in, like if I were to come in and speak to you as a financial advisor, it looks like there are options where I'm going to walk out feeling pretty positive about whatever it is that we decide on moving forward.
I think so. I mean, oftentimes it's just having that peace of mind, coming in, seeing what your current situation is, and kind of sift through all the noise, right? Because in this 24-hour news cycle, you can talk to 10 analysts and they're going to have 10 different opinions, right? And obviously, the odds are half of them are going to be right and half of them are going to be wrong. So you really want to just sift through the noise and look at your specific situation, and not let fear drive everything, right? So you look at something like what we saw in the news as far as the bubble coming.
Yeah.
You don't want to overreact by selling off your assets because you think the bubble is coming. You really want to just be allocated properly, right? And once you kind of get your proper allocation, then you kind of, the noise kind of goes away because you know that you have a plan. And again, I go back to that analogy of giving every dollar a job, because you can participate in the market and not be fearful of a bubble, as long as your short-term needs are met and you're not putting too much risk in the market. And people, I can't tell you how many times people come in with a look of stress on their face because they just turned off the radio as they're walking in. They're hearing the news. They can't avoid it. And they look at me and look, I want out of the market. I think everything is like the news clip said, right? Is we're in a bubble and I just want to sit in cash. And once you kind of illustrate to them that they can have a plan where they can still participate in that growth, they can still do all the fun things that they were planning on retirement, and they don't have to have any stress because they have a plan where they're insulated from that downside. But when it goes up, they get to participate in that upside. They get a sense of calm. And that's really the goal, because you want to go into retirement with a plan, because I'll tell you one thing that can happen, Jeff. Bubbles are real, right? So
yeah,
if the listeners out there right now, if they're those individuals that, again, have worked hard and have over the past 25 or 30 years saved for retirement, but they haven't really looked at their allocations, then a bubble can absolutely impact them. Because imagine this.
Right.
You've worked hard for 30 years. You've put in your papers to retire. You retire today, and all of a sudden you do see that 30% drop in the market. And everything that you've been invested in is the same allocation that you did when you were 21 years old. So you're very heavy in the market, and your accounts drop, say, 30%. Did you know that if you drop 30% in the market, it takes a 42% gain just to break even?
Just to cover the loss.
Just to cover the losses. So if you retire, and then imagine this: if you retire, you get a 30% loss. Plus, you've planned to retire. You've planned to take a cruise or pick up a new hobby. So you're taking income out of these accounts. What happens there, which a lot of people don't understand, is as the market comes down, if you're taking money out, you're locking in those losses. So you're not giving your account the potential to rebound. And what that's called is sequence of return risk. And that is a big risk that a lot of people don't understand or don't look into. And that's why we always encourage people to just talk to a professional about blessing your plan. We have some DIYers that kind of just, they watch some videos, listen to podcasts, and they want to do it on their own. I would always encourage them to at least get a second opinion, because there's a lot of obstacles out there that you're not aware of. And one of them, especially in a situation where there could potentially be a bubble, is sequence of return risk.
There is something you just mentioned that really, I think, probably hits home with a lot of people, especially if you are one of those DIYers, is that there's a lot of talkers out there that they sound really good talking about the things that they are, but they are not the financial professional that somebody like you are, Jimmy, you are the financial advisor that has gone through all of the training and everything else. And this is what you do for a living. You're not a podcaster for a living, right? You are a financial advisor for a living, where many of those people are podcasters for a living, and they're using financial advice as a way to gain a following. And for a lot of those people, Jimmy, they use a lot of these news stories to create what I would call, I don't want to call it fear and panic, but they absolutely use it for trying to pull people in. And
you're absolutely right, Jeff, because I've heard this 1,000 times. People will come in and they'll say, I wanted to ask you a question about something I heard on TikTok or something I saw on a Facebook reel, right?
But this guy on YouTube, he sounds like he knows what he's talking about.
Right. And so the key thing for everyone to understand is it does not take any licensing or credentials to post a TikTok video, right? Or post a Facebook reel. So you have a lot of misinformation out there and a lot of people that are attacking people's fears. And so what I really encourage, and I've mentioned this in the past in some of our other podcasts, is that it's all about education. As long as you provide people with enough education about their situation and then let them most of these people, like I said, they've worked hard. They're experts in their field of expertise. They just don't know a lot about retirement because it's not something that they teach in school. As long as you provide people with a good level of education, that's what my job is, really talking about investments, financial planning, taxes. When we can provide that type of education, then you can make an informed decision. So that's what we do in the workshops that we do, as well as the in-person meetings that we do in our office.
I love that. By the way, for people you're listening right now, I want to make sure that you like and subscribe to the podcast, because that way you can get a lot more of this information from someone who is a financial advisor and not someone who's just looking for likes and follows, through the world of social media. Jimmy Lynn is a person that, will talk to you about your particular portfolio. Maybe you are working with someone right now. And like you said, Jimmy, maybe they've been with that person for the last 20 years or so, and they just kind of need some different eyes on it to see if this is what they need to be doing moving forward. Encourage you to go to the website at rightpathtoretirement.com. Again, that's rightpathtoretirement.com. And Jimmy, of course, you'll do that initial consultation, that first time to kind of look at that portfolio and see where people are and kind of, give them that direction of where to get that money to go do its job.
Yeah, absolutely. We invite people to definitely go to our website and reach out to us if they want that complimentary consultation, whether you're a DIYer and you just want to kind of have your personal plan blessed, or if you are with an existing advisor that you've been with for the past 20 years. Oftentimes what we see is that those advisors have done a great job during your accumulation years and they're focused on those returns. But again, we've said this in the past, retirement and the distribution phase, there's a lot of unknowns and it's a different ball game. And so we definitely love to talk to those people, see if they have a good plan or if there's any recommendations that we could make in this new phase of their life.
All right. The rightpathtoretirement.com. Again, that's the rightpathtoretirement.com. Financial advisor Jimmy Lynn, thank you so much for taking the time today to talk about the stock market right now and kind of where it is and help people kind of, especially start to look at things a little bit closer. Make sure you subscribe to the Right Path to Retirement podcast. My name is Jeff Miles. Jimmy, as always, it's a pleasure, man.
All right. Thanks, Jeff.
Insurance products are offered through the insurance business Right Path Wealth Management. Right Path Wealth Management is also an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by Right Path Wealth Management are not subject to investment advisor requirements. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Right Path Wealth Management is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained by sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Right Path Wealth Management.